Okay, so let's look at the plan. Notice, first of all, before we get into recoveries, let's understand what's secured and what's not secured. So we know that there's $200,000 worth of collateral value, and we know that there's 400 or $500,000 worth of claims, right? So you have a $100,000 claim by the first liens, and you have a $400,000 total claim by the second liens. And we actually have to bifurcate it because you have $200,000 worth of collateral value, which means the first 100,000, the first lien gets. So they're fully collateralized. They're over collateralized by $100,000. Now the remaining $100,000 of collateral value now gets collateralizes the second lien. But there's a 300,000 of the $400,000 claim. There's 300,000 unsecured claims. So they're bifurcated into two claims, right? 100,000 second lien is secured. A 300,000 second lien is unsecured. You now have two claims by the second lien lenders. Okay. Now all the general unsecured claims are the same priority. The second lien unsecured portion, along with the payables and the unsecured notes, are all pari passu, as it's called. They all have equal status in a bankruptcy process, and so to the extent that the out-of-court restructuring should mirror, at least closely align with what that would look like. And again, it has to, because otherwise people would just do the bankruptcy. The people who would stand to lose would just go for the bankruptcy. So everyone here should get equal standing. Now, there's 610,000 unsecured claims, right? Now, they should theoretically get 41.3% recovery. Why? Let's kind of go through the now three different claims classes. You have, or two, I should say. You have the secured claims are getting 100% recovery. They have 200. There's $452,000 of total value, right? So here we have a column that says, what's the value available? 452,000. Well, so we go through the list of who gets what first. First, these two guys, the secureds get theirs, so they get full recovery. There's more than enough to go around for the secured claims, the 200,000, and the remainder $252,000 of asset value, right? Has 610,000 nominal claims against that value. Well, 252 over 610, that's 41.3%. So in aggregate, the general unsecureds are going to get 41 cents on the dollar. The thing is, they're actually going to get a little bit less. And the reason why they're going to get less is one of the assumptions we talked about, which is that the proposal calls for them to give up some of their recovery to allow the original equity to retain some value themselves. So I said, hey, I want to retain 5% of equity value for myself. So what does that amount to? That actually amounts to $6,000 worth of value that's going to come out of this 252,000. How do I get there? Let's kind of run through the numbers. So I have no more than 340,000 liabilities allowed post restructuring. That was one of my main assumptions. I'm going to be able to back into what that means for equity. That means that at $452,000 of asset value, that means this thing is going to have the difference. 452 minus 340, it's going to have $112,000 equity value. Well, what's 5% of 112? That's 6. We sort of are rounding, right? And so the remainder belongs to the various claims. 6% stays with me. So I'm going to own, my share of this is $6,000. So I'm going to have to take $6,000 worth of value out of these people's recovery, right? To figure out what their ultimate recovery is, because they've agreed to to at least give up a partial recovery to the equity, right? So here's what that amounts to. Remember, part of the assumption was that all three unsecured claims are taking a hit for the benefit of making me happy. So instead of 41.3 cents on the dollar on the 300,000 unsecured second lien claim, I take 40.4 cents on the dollar, right? That means that 3,000 of the 6 is coming out of my pocket, right? Because I've got the biggest claim. Then about a third of that, 1 is coming out of the accounts payable pocket, and the unsecured, about 2 is coming out of their pocket. And I've provided you guys an Excel spreadsheet that shows you how we split up these recoveries. So again, we've got $252,000 worth of recovery available to the general unsecured claims, which amounts to 41.3%. Now, we talked about how because the owners want to keep $6,000 worth of equity as part of the proposal, that $6,000 worth of equity must come out of that $252,000 in available recovery to the general unsecured, which means there's actually $246,000 of total recovery available to the general unsecured. How do we take that now? There are 3 claims, right? Unsecured second liens, accounts payable, and unsecured notes. They come out pro rata. In other words, in proportion to the magnitude of each person's claim. So that 6 is going to get broken out in proportion. So the unsecured claims have 121,000 out of the 246,000 worth of claims. Whatever that comes out to, let's kind of hit F9 and see what that number amounts to. So 49% of the 6,000 is going to come out of the pockets of the unsecured second liens. And I hit F9 to evaluate a cell. The thing is you have to hit escape to get out so that it doesn't sort of change the number to a hard-coded version of that. Here, let's do the same thing. Hit F9, we see 18% of the 6,000 comes out of the pockets of the accounts payable. And then, the remainder, 32% of the 6% of the 6,000 comes out of the unsecured notes. And the hard numbers come out to, 312. We can increase the decimals. You can see that that's what this generally amounts to. And then if we take that out of the full recovery, we get 40.4% after this payment to the equity owner. So instead of splits of like 124, 45, and 83, you get 121, 44, and 81. Okay, let's get back to our manual and let's kind of wrap this up. So now we understand what the total recoveries are going to look like. So 40.4% for the unsecured creditors. And now we have to combine all this together and kind of draw some conclusions. So let's look at the first liens. So they have a $100,000 claim. They're going to get a $100,000 recovery because, again, they were secured. Here, it's all just going to be debt reinstatement, right? So they're exchanging debt for essentially the same kind of debt going forward. They're going to have 100% recovery, no equity. The second liens, because they're really 2 claims combined, one secured, one unsecured, their recovery is going to be different from all the other unsecured and different from all the secured. The second lien recovery ends up being 55.3%, somewhere between 100% recovery, because they got 100% recovery on $100,000 of their claim. And on the remaining $300,000, as you recall, they only received $121,000 recovery, right? So $121,000 plus $100,000 a fully secured claim gives you $221,000 recovery, which on a $400,000 claim is 55.3% recovery. Again, so it's not 40.4 because you have to factor in for the second lien perspective, they've got full recovery on $100,000 of their claim. It's only they get 40% on $300,000 of their claim. So together, it's about 55.3%. But notice here they made an elective decision, and we didn't specify exactly what kind of owner they're going to be, just that they're fine with equity. So theoretically, you could have had it where they get no recovery, much smaller recovery in terms of liabilities, and maybe had more equity. But the way the numbers worked out for us, because we said that we specifically identified that we want these guys to be 5% equity owners, we ran numbers where the proposal calls for 106. This is, again, kind of arbitrary. We know that they get $221,000 recovery, and this is part of the negotiation. If the owners of these claims are comfortable with equity, they may want to be the majority equity owner. So they're going to say, okay, fine. So give us, like 50 cents on the dollar recovery or I should say 25 cents on the dollar recovery in the form of debt, but another 25 cents on the dollar recovery, give us in the form of equity. So we're going to look at the numbers underlying this in just a second, but here they've become, if you give $106,000 worth of equity value to the second lien, right? Again, part of this 221 broken out in this way. They now become the 95% equity owners of the business. Accounts payable does not want any equity, so they get their 40.4%. Unsecured gets their 40.4%. Notice these guys are treated the same And you know that these guys were kind of treated as half secured, half unsecured. Let's look at kind of the math underlying this. So here we have the decision. Let me just kind of color code this so it's easier to see. So how do we arrive at the equity? Well, we said, okay, you have 221,000 in total recovery, and your liabilities are basically a plug. I want no more liabilities than 340,000, and so, you know, that means because these guys just want debt, they don't want any equity. It's kind of a backing into it. So if I have $340,000 worth of liabilities, the accounts payable are getting 40 cents on the dollar, which means they get debt reinstatement of 44,000. The unsecured notes get 81,000 on a $200,000 claim, and these guys are made whole. That leaves just $115,000 worth of liabilities before you sort of get above your max. And so by default, that's the most amount of debt that the second liens can take without getting into an over-levered problem. So that means they're going to have $106,000 worth of equity value. And let's see what that means in terms of shares. So $106,000 worth of equity value. What does that mean about how many shares? Although I didn't explicitly ask for this, but you can kind of run the numbers. In order to make these guys the 95% equity owners, because remember we agreed to be diluted no more than 5%, no less than 5% equity ownership. 95% of the total share count is going to be 2,280. The total share count is calculated by looking at the current share count and dividing that by the 5%, dividing by the ownership. The 5% ownership that we're going to have. That means you're going to have total shares of 2,400 if these guys want to be 5% owners, which means that the delta, the 2,400 minus 120, that's this 2,280. We could have actually counted this a more direct way, which is this minus this, which got you to 2,280. So mechanically, this is the number of shares that have to get issued to dilute the equity to 5%, and to get me to be a 95% equity owner.